All right, up and running. Okay, so I have no camera today. I'm not really sure why, but it's just a little black square. So I have to fix that. Anyway, looking at today. Now, hopefully you guys are aware, I've been just marking out the buy and sell spots, or not buy and sell spots, the bearish, bullish positions as I see them on occasion. It's not like in real time or anything, just when I have a few minutes. I've been just marking these things out so that, they show up on the Zoom. So if you're tracking them, you should be marking them out in real time and tracking them as they're happening. But, I've been marking them out on the chart and they're syncing up on the Zoom here. So, okay, so basically what happened today, if we take a look at yesterday, so we had the 30-minute was able to push up and stay above for a while. We get into this situation right here, which is not an uncommon situation. And what it is we have the bears saying we're very close to zero. We could see everything under zero like this. So they see a bear. They see a bearish move. And the bulls say, well, we could see a zero test and it could come up. And the way that this functions is that the bulls want to see the bears get too enthusiastic. Which gets them to make mistakes. So whenever I say something like an enthusiastic bear or enthusiastic bulls, what I mean is that they're jumping the gun and they're acting too quickly. So Wednesday morning, you can see that the 30-minute tension, we finally got our 30-minute zero test. And that happened right there. And you could see there was some response from the bulls. Well, it pushed up and we got a switchback sample, and the bears came in right here, and I probably should have marked them all out. And the bears got a zero test on the way back up. And you can see as we moved down, the bears failed to get 30-minute tension down under zero. So if there were bulls who were trapped here or anywhere, if their holding in the market turns them over, they were not getting liquidated. And that means that the bears are failing to trap in somebody and get the work done. And the work is pumping tension in your favor and trapping people and getting price to move in your favor. Now, they did get prices to move in their favor. And that's a good thing. And that does take work, but they were unable to get the probabilities to shift in their favor. Well, I think what happened was that this morning the market opens and look, 30-minute, the tension did not push down immediately. Again, we had another 30-minute zero test, and there was a response. This is such an interesting market to see it stair-stepping down like this. We have them plunging down and the bulls respond. We have it plunging down and the bulls respond. And then the second time when the bulls responded, I think this is what happened. These guys here dumped because they saw that this response basically was failing. The bulls were not able to get 30-minute tension back above zero again. So this is just the higher level structure for day to day. You could see that's basically what's gone on here. This has been about the bears for some reason throughout this day was not all that special. It was this day that changed everything. This section here where that we saw the bears just coming in, swamping the market, and they just never stopped. And it ended up that the bulls caved right here. This is the moment, I think, when the bigger institutional bulls decided that they were going to unwind, unleverage, and the bears just sat back and, everybody on the same side here where you have the bulls trying to sell and you have the bears trying to sell. And that's what causes these extremely violent moves, is when both parties are on the same side. I mean, hopefully you could see this generally in the structure. I think what was happening here was the bulls were right here. The bulls saw this moving higher. I sure did. And I was waiting for the zero test. So I was in a waiting pattern here. I got the zero test. The bulls pushed it up, but the bears responded on that. And so it was sort of like, well, I need to trap some bears in. So you're in a waiting pattern until you see the response, until you see the bag holder, you know who's losing, you know who's winning. And we just never, through this section, we just never trapped in any bears and made it happen. It just never really worked. And so I was just constantly in a waiting pattern through this section. And then I think here it became clear that the bears were taking over tension. And then you can see as the bulls got liquidated, we got work done. And the work is price moved favorably and tension pumped. That's work. Okay, let's look at the intraday so that you can see today. And I'll zoom this out a little bit more because I think this is all, I think this section here, this from last week, is absolutely related to what's going on right now. This is all one big situation that's happening. All right, so let's just quickly look over the events of today. So we have this morning, the market opens, and immediately we find some bears who react quickly. They pump the market down, and this position right here drives the market into a bullish sample. So the bears immediately say, let's push those bulls. They shove it down, and the bulls just don't act. They just nothing. They just didn't do anything. No response price-wise, no response tension-wise. Okay, so you could look at this, well, no, you can't. They just didn't, there was just nothing here. It drifts down some more. We trap in a little bit more retail. The zero test is sort of looming over our heads. And there is this delayed response. I don't like that. When you have a zero test, what the best situation you could have is a nice liquidity right at the zero test and everything lines up, and seeing no response at all from the bulls when they have a zero test is not what you want to see. Okay, and you can even see right here into the low, there was acceleration. So these guys probably got liquidated down into these lows. That's really bad for the bulls, even with the zero test. I like to see these things line up so that you get them all at the same time. Well, it turns around, and these bears right here who are getting, essentially it's a switchback where you go down and you push back up. These bears right here don't do much, and there's a good reason for it. There is a broader zero test going on. I think they're waiting to kind of see. Well, the market moves up, and you can see that the bulls have, if you were just going to be a meta trader, meta step back, just look at the bigger data, the bigger picture here. This is a problem. The bears or the bulls just couldn't make anything happen. They failed here. And so then the bears get a position at the same spot here. And it took a while, a delayed response. And you could see that and the reason I point out the longer term stuff is because this is important to this. It pushed up, and I think anyone who was lingering here as a bull decided they wanted to sell. And I think that's what was going on in this section here. So we had this delayed response, and then everybody comes in. So this is a little bit different than the typical bearish situation where the bears come in, they take forever, and they grand slam. This is a situation where the bulls just were wrong. They're just wrong. It just didn't work. And then they wanted to dump. So these guys don't respond. These guys do respond. This position, I think, is in waiting. So it's sort of a failure. You can look at it as a failure. There was not much going on here, but the second one definitely. So right here, if you went, oh, okay, it's bullish because they failed, fine. Then you had to see this start to come down, and then you had to say, okay, this is now bearish because they're hitting. Okay, so at this point, you are bearish, and if you're paying attention to the major zero tests and how the bulls are acting, you see that probably what's going to be happening here. These bulls get another sample after this whole situation. Of course, at this point, you really shouldn't be expecting a response, and you don't get one. And tension just doesn't even flinch, and it drives all the way down. Now, what's this low all about? We have a decay retest, multi-day. Here's the low, comes over. Here, I'll show you right there. So you can see where the zero test was. And at that zero test, we get trapped orders, we get some new highs coming in, and this sort of sets the low. It's a risk reduction. Have the bulls suggested they want to play? I'm not sure. Maybe a little bit through here because there's maybe a little bit coming up, but then after these events, I'm really skeptical if the bulls really want to play. There's no other options for the bulls, and this range is just enormous. One of the things I think that gives this credence is a little bit more of an irregularity, which is that the range is enormous. So the question for most of the move down was, what's going to end this? Where? Why? And so a decay retest in this kind of a market where the range is just mind-blowingly huge, I will look at these decay retests just because there's nothing else. It's just like, what are we doing? So the decay retest was, in that regard, because of the extreme volatility, I think okay. I don't know that I would call it 100% amazing. We hadn't seen the bulls actually really trying to hit today. We just saw failure after failure. So there's no expectation that they were going to try anything. But because the range was so huge, there's a lot of bears who are like, well, where do we take profit? So you see a risk reduction, and that's a place for some buying to come in because it's just, there's nothing else to do. Well, then we get a wide short, so it goes wide, and then it retests the shorter one, so it's wide. The wide part and the short part, I don't know why I drew an R. And the second sample there is here, and that's why that's marked. So that's our decay retest. And this is the wide short, so it's the more conservative one. Decay retest. And those are why those positions are there. The big question now is, well, what comes next? Are there any bulls getting destroyed? No. These guys aren't here. These guys, no. There's nobody holding on an intraday scope that's holding. So no. So what's going to happen tomorrow? And we've been in this situation a million times. The question for the bears is, can we do more work? Well, how do you do that? Well, you're at 44%. If they did another day like this, we're going to be at 70% tomorrow. And really the only way we get to things like 70% is with some news, some external event that's just terrifying. You just don't really get to 70 for no reason. There's got to be like a driver. So at this point, how it's not a message of a matter of can we or how, will we? It's can we or how are we going to pull that off? And so a cool off would be useful for the bears to do. They don't have to do it. They could do something like where they pump it down and then, we hit a bottom and cool off there. But cooling off makes a lot of sense when you get up to like 40 or 50 at the close, because that means if you did another day, you're going to be hitting 70%. And then people are going to start asking questions like, why? So a move back up like this could be fine, and then trying to push back down to these lows, or, that would be the extreme. An extreme cool off for the bears would be all the way back up here and then down. Likely, something where it just moves around a little bit and then continues. This is more likely. This is the upside limit. I think if we did more upside than that, the bears are going to start to have to cover. It's going to become a problem, and we'll see conditions change. So this is the eyeball right now. We want their eye in this like cool off thing that can allow us to pump again. We need that. So right now we have a short-term bull where the bulls have the opportunity to come in here and have a precedent to drive the market up to cool things off tomorrow. If you don't cool things off, you run into issues, big ones. So tomorrow morning, you'll be looking at this velocity number. Can we get a zero test? That'll be the bears, but they're going to need to trap some bulls in. So if we saw decay move down, we could get a bullish sample, and then they could try and turn them over. But bears, as you know, are just awful at structure. They're just awful at it. This whole setup was sort of a unique situation, I think. We don't see this kind of stuff very often, luckily, because I don't really like these kinds of days. I think their structure is just a little crazier, a little more haphazard. It's not as easy to participate with. You can't take your time and use things like, collecting data and making reasonable decisions. You have to just kind of see the thing and go for it. I don't really like these kinds of days. But we have a short-term bull coming in here, so there's a precedent to get to when the market opens at least flat or a little bit higher, so that we could cool off tension, and then the bears will want to take another stab at it. If the bears tomorrow fail to take a stab at it, we have immediately, there's a target, just a big target right here to get where there's likely a bunch of market makers who got stuck with negative bad inventory. This is not buy or sell. This is just negative inventory. Stuff they don't want. They've had to hedge and deal with. It's stuff they would like to offload quickly. It's going to be the immediate first target is right here. The second target is going to be this right here, because this is where I think the last time that the bulls had their eyeball on a good situation with this right here. They were thinking, well, we think the bears are going to mess up and drive this higher. So this is the first target. This is the second target. If the bears screw up, if they get trapped in, they make a mistake, if we get elasticity, which is not bears failing means that they hit and pump tension. So you see some sort of sample and then tension gets pumped, so they're there. If they did this and then after pumping tension down, got trapped in, price turned them over, then yeah, we're going for those targets. I'm marking these out now so that if it happens, you're not scrambling to say, well, where do you think it's going? This is where I think it's going. The first spot's going to be the market makers stuck here. The second spot is going to be the any trapped bulls from the last time they had something to see. The downside, if the bulls get trapped in and screw things up, we're going to have to get a little wider for that. And I'm going to take a look at a different chart to really describe this, because I think that the things going on are not necessarily intraday things. They're just not stuff that you can sit and talk about point to point. We blasted through this area here, which I thought was a good trap for the bears. Lots of bears got stuck in this area and we shot up. We got back down here for a retest, and I think a lot of people probably bought into this here thinking, oh, we're going to retest this trap. It got a little low, and now we're getting another stat ADI signal, just like we had before. This signal is where that we statistically, if we reverse engineer the advanced decline index, it should be about here, but it dipped down. It got down to numbers that are impossible to create, under 4,000. There's only 3,060 stocks. I don't know why I drew a comment. 3,060 stocks in the exchange. So you can't statistically say that there's more stocks down than there are available stocks. So that's why this is an issue. And again, if you remember how this works, it grinds up, you get a slow move, and then the real signal is when suddenly you have a massively quick bar down and the stat ADI just doesn't mirror it. You see from here, price moved down from here to here, and the stat ADI moved from here to here. It should have gone all the way down to here if it was going to be the... So you can see there are these moments where you have these massively quick moves down, and that's the point where you need to pay attention to the stat ADI and say, well, what's this doing? So, a slow move and then a quick move, sudden quick move down. And if the stat ADI is rising and it doesn't mirror that at all, you're going to go, oh, okay, I see that. I see what's going on here. We're looking at bullish pressure coming from just the structure, the hardcore, long-term, day-to-day, month-to-month structure. So this is going on. Now, if the bears, I want to talk about the bearish opportunity here on the bigger structure so you can understand what's happening. And I think this is really important. This point right here, not this one, forget that one. This one is the pivot. And I didn't even mark that out on the chart. I should probably do that. This is the pivot, which matters. And the market came down to this area and sort of fiddled around, and now we're under it. So the natural thing to do is, can we stay under it? If we turn this pivot over, if we get a test on it and it doesn't just pressure it and come back up right back through it, which it already blasted through it. So, you have to be skeptical here. The market's going to want to do it again. But the issue here is usually you get you push down, you get a pivot like this, right? This one. And then it pushes down and it retests and you keep going, and then you get a pivot like that again here, and that's the bottom. It's not usual that you get a pivot after a pivot. This is just stair-stepping. If we're constantly getting pivots every time, it's basically just diving stops. It's not actually bearish. It's just diving stops. We're just screwing people. Screw. And this is a problem, because this isn't bearishness. Bearishness would be where you get your downside pressure and you just keep going down, and then you get another downside pressure, and that would be a bearish trend. Having those signals all the way down is not how this works. That's not how trends work on, it shouldn't be how it works on any indicator that checks things like momentum and internals. You should be able to finally get the market to do the work for you so it can push down without having a ton of force. This looks like just a ton of, why are you having to push so hard every time? It's because the market wants to go up and someone's pushing it down, and these two things are going to fight and fight and fight. And if we don't see one capitulate or give up, then it's going to eventually win. And pushing down is expensive. I mean, a lot of people have to change hands with shares and money when you do these really hard pushes. So my problem here with this whole shove down isn't that it broke this. It did break it. So it's going to have to break this one and then stay under that without a signal here and then keep moving down without constantly triggering these strong pushes. You can't burn all your energy every time you make an inch in the market. And in my head, this is an inch, not a mile. It's a little tiny advancement in the market moving a little lower. You didn't like, it's not that much. This is not that much of an advancement, in my opinion. And you're wasting all your energy just to get a little bit, That's not an effective trend. So we're going to have to keep our eyes on this. This is going to be a big deal. If the bears come in, they get this, it's going to probably drift back up at some point, want to retest whatever that level is, and it's going to want to come down. The bears have got to get this under this level without extreme numbers, and then it's going to have to stay down, and we'll just keep moving down until we get extreme numbers at some lower price. Okay, so the structure here is a big deal. This could potentially go like this. This is the bullish case, is that the bears had to work too hard to get things down. They didn't get the market to do the work for them. They're burning all their cash and energy getting down here. And if they can't keep it moving and get things working in their favor, it's probably just going to be pretty easy for the bulls to come in when they finally do get their opportunity, which will probably come tomorrow or the next day, to try. And they're going to be looking to push new highs. So if these bears, who are currently in the driver's seat, can't pull it off, remember, there's a looming opinion that knows we're getting to this high, that knows we're hitting 39.50 probably if they fail. So there's risk for the bears. There's definitely risk for the bears, but don't think that just because that this is possible that it's going to happen. This is looming right now. This is looming in the way if these bears fail and they can't make it happen, they would need price to come back down and stay under. And then at that point, it's like, okay, you know how breakouts work. So this is what I'm looking at in the background. And I think this is a big deal. So I think tension is absolutely going to model this. We have it hot. We need to see it cool off before they can pump it more, which should look a lot like the market testing and then pumping. And then, yeah, they need to push a new low if they want to get any work done. So these things all are lining up, but you have to go to the top of the pyramid here, which is, I think, structurally, the bears are actually having a pretty hard time doing this work because they have to push so hard. I mean, it's just so hard. And that's what I think is going on with this. So keep that in mind. To sum it up, so if I just totally yammered on too much to follow, this pivot needs to stay above the market if the bears are going to have a chance. If we get above this pivot, if we get above this level after this blast off, I anticipate bulls to get very aggressive and start eyeballing 39.50. Okay? That's what I'm talking about. That pivot's got to stay above price going through to now into tomorrow's close. And the bears, if they keep that pivot above there, need to push a new low. You can't just sit in ranges all day. Yeah, that's not bearish. So if the bears are using all their money to sit in a range, they're about to get their faces ripped off. Okay, let's take a look at the options market today. Not a whole lot went on. We saw some activity here at the 3,700. People plopping out of the money puts, which I don't know if they're buying or selling those puts. It's hard to tell, but in my opinion, out of the money is not the thing that matters that much. It's the in the money ones that matter the most. And we don't really have any going on. This one was for like a second there. Prices were really close to looking at in the money with that. That's about it. It was mostly a volatility play, which we see yesterday. We had something like that too. That sort of showed up. A lot of people taking calls and puts, depositing a bunch of money so that they're expecting extreme volatility. Otherwise, they lose that cash. This was here with some puts, which effectively, I think, muted a lot of this move up here. This is really common. You see the in the money puts instead of out of the money puts. This being a hedge from whoever was at the lows, they hedge it, and it makes it difficult for the market to continue once you've hedged because of the risk and the way that it works. So this was this in the money put situation, which is about 1,000 contracts, which isn't, it's a little smaller, but then the lows were not very good. The bulls, it was like, well, were there even bulls in the lows? I don't think so. I didn't see any. It looked like the bulls just did terrible all day. So anyone who was there did hedge that. And then moving down, I don't see any in the money calls that did great. It was, I guess, maybe a little bit there, but I like things like this is the sizes that I like for in the monies. So just not much going on with options. And again, our options market, we're looking at these numbers here, and we had some lower options numbers yesterday, 30K, at least on this. And remember, this is just regulars. On the SPX, which you can pull up in your options things, you can see we had an increase in options trading on both, which tends to be bearish when you see numbers go up and we're at the 50K. A high amount would be like 110,000 contracts. A low amount is really, it's like 20 or less or something like that. So this is about the range. We're sitting about 50. So it's getting higher, and it was a big increase, which tends to be a bearish thing. People are taking up insurances and things like that. The volume profile here, the auction profile, you can see that we pushed all the way down here. Lots of things going on here, and the point of control never moved, which from a commission standpoint, there is less and less money here, less and less commissions at lower and lower prices. Lower equals less money. That's what this looks like to the market herself. She says, I had a bunch of commissions up here. This is where we made all the money. I just love the money. And they moved down, and they were like, there's just a little money down here. It's not as much. Let's go back to where all the money is, and it'll just go. The market's just looking for commissions. It's fundamentally geared for that. So looking at this, its prices are not going to want to sit here. Obviously, it's a you could call it low volume node, but in my head, it's actually a low commission node, because there's no money there. Why would the market sit there? Though sometimes the market will sit and try and fill that in for some reason, but it eventually does. It won't stick there. So we just have to sit here for a little bit while longer. You can see that there's not much more. So if the market just did this for a while and then made a decision, it could get the same amount of commissions down here that it had up here, and that'll make the market much happier to have done all this work to get down here and collect commissions and stuff like that. Another thing I want to point out that I think is just blindingly clear to me, and I posted about this on Twitter, so if you go pop on the Twitter, I made a chart. Did I put it on Twitter? No, I think I just stuck it in the Discord. So this is moving up, and it means that there are less dollars in the big pile. This is a pile of dollar bills. There's less dollars in the pile in the market. And it's because I think it's going into accounts. When you take profit, you convert your position from a share into money. And that money, instead of holding a share in your account, you draw money into your account. So this less money. So this going up shows you that cash is moving into accounts. And it's not so much that their account balance changed any, it's just that they converted into dollars. And that took money out of the market's pile. So We see that, then we see the equities going down. So shares into, where are they headed? Into the market. The pile got bigger. So per share, they're make them cheaper so people will buy them. So that means out of accounts. I'm going a little slower here because last time I went a little too fast. Out of accounts. So the pile was like this, and now the pile is like this. It's bigger. There's more here. So we're seeing people convert from shares into dollars. It's covering. And you see debt goes down, so the pile got bigger. We had a pile of money, and the pile got bigger. They're like, so take these off our hands. So they drive the interest rate, the cost down. It's cheaper. And that means that people are paying off credit cards. And then we call credit cards margin, but it's a credit card. So they're paying off their margin. So when you take profit, first the cash goes here. You don't get to choose that. Then it goes here. So when you see people taking profits and covering their margin, and then you see the cash go increase in costs, it's because people are taking profits. They're converting their shares into money. And it's clear as day to me that that's exactly what's going on here on a major. This is major. This is multi-market security type stuff. This is like the entire exchange. If the entire exchange was one thing, that's what the exchange is doing today, was people just covering. I don't know if it was dumping. I don't know if it was taking profit, but definitely people closing out positions. Or you could call it deleveraging. Well, not really. You can't really call it that. Deleveraging is this relationship. When you include this in there, it's no longer deleveraging, because leverage would be your debt to asset ratio, and they're getting actual cash. So I think it's just covering. And then looking at gold, if we just think about this, one thing I think is happening here is I think a lot of people bought physical gold. They went out when the pandemic happened. They said, give me piles of gold, give me coins, give me anything, give me everything. And so, yeah. You have a big drink. You finish up that and I'll give you some milk. So physical gold, I think a lot of people bought in. And if I scroll this back, we can see probably how much a lot of people are paying here. Well, you can't see it on here, but, is it marked here? Okay, there it is. So 2,000. We got people paying 2,000 for their gold, 2,000 an ounce. What's nice about people holding physical gold is you don't feel, the feel is less. You don't feel the fact that you're down a bunch on your physical gold. So it doesn't hurt the same. So a big pile of gold doesn't hurt the same. So we can drive this down significantly further against people holding physical assets than people holding contracts. That's important. And so I think a lot of this move down, this thing that this pattern tool is recognizing, is that people were flying out of the dollar into a safe gold security, and now they're holding something that they think is more durable than an economy. It's true, but they're not really feeling the fact that this is just, they are losing their money. And that's what's important here. We are not toppling contractual positions. We are toppling physical. It is not the same. So different. I mean, if you buy something, and I tend to be this way, my wife will complain about it. I like to use things until they're completely destroyed. Like I'll wear shoes till they have holes in them, and my wife comes home and says, "Here's your new shoes. You should have bought new shoes. You look terrible." And I'm like, "But they're still good." So I will take a physical assets and I will drive the value into the ground because it's easier to do that. But if I owned a contract based on my shoes and I was watching that value, I would be dumping that thing so fast. So physical things are easier to destroy the value within them. It's just easier than contractual things, at least because we have like infinitely liquid markets basically, where the liquidity is a function of getting products from one person to another, not liquid and available things. It's the speed here is insanely fast. So contractually, this is physical. So if you're waiting for this to bounce or something like that because people are getting stopped out, there's no stop loss on owning a physical bar of gold. So I think a lot of these people moved over to gold to be safe, and that's what's happening. Another event that's a big deal is Biden's a $9 a gallon kind of guy. He just loves he wants to make sure that he gets his taxes if you go on vacation via a car or plane. So if you use gas, he wants to get his tax. He wants it. And this, I think this is a similar philosophy to the vacation. If you come from Utah and you go over to Florida, you expect to pay like triple in just being alive because you're on vacation, right? You're just on vacation. This is the similar philosophy I think that drives the whole like expensive gas. It's like, well, you're doing something special, so we want to collect our tax. That's Biden's mentality, whether you like it or not. So we're seeing rises in the fuel cost. There's other reasons for it, but we're also seeing the cost in the gallon. This is the gasoline. This one's gasoline, not just oil. And we're seeing those costs go up. And this, I think, is also shifting the behavior of market participants because if gasoline goes up, of course, the average worker is now accepting a hidden tax. And that hidden tax is at the fuel pump. So if you don't own an EV, which, come on, they're still stupidly expensive. It's dumb. If you don't own an EV, well, then you're going to be paying in taxes, which means that your nice, friendly, whatever 28% or whatever your tax is actually significantly higher. And that's going to cut down on the spending in equities and stuff like that. So I think that the spill off, if you've been paying attention to Amazon, Walmart, there are some other, these are basically the ones that capture all the retail market essentially these days. Maybe some other ones, but most people shop at these places. Sure, there's Target, TGT, I think, which did you know Target is one of the oldest symbols on the exchange? Did you know that? Go look at their IPO. You'll be like, holy crap, Target is freaking old. Anyway, Target, I don't know, Smith's. There's one, Menards, is that Menards? And somebody from the other side of the country is going to have to tell me what it's like. I think it's Menards. There's a couple of others, but I think Walmart and Amazon are the biggest, and they've been spilling off. And I think they've been spilling off because they recognize that cost, the average citizen is getting hit with higher taxes right now, and the average citizen doesn't know it, and so they're going to the pump and filling up. And that just basically means there's a projected lower revenue for next year on majority of retails. So, and I don't mean retail like retail trader, I mean retail like, shoes. My shoes. So that's why I think we've seen a spill off. It's this mentality of the current administration being okay with higher oil prices and stuff like that that's caused our big spill off, and it's putting pressure on the tech market because tech is discretionary. I think a lot of the technology products, people have computers and phones, but if we have a high tax, you're probably not going to be as eager to go buy a new cell phone next year, even though Apple is going to make it slow and laggy for no reason. So this is the state that we're in here. I see people taking profits. I hope that I've motivated why I think people are taking profits. I hope that you can see that there's a commission thing going on here and why the market's hanging out in this range and maybe sitting here and what that's going to mean if we sit here. I hope you could see that there's not a lot of insurance policies going on right now. I think it's people just covering, not people getting into new positions. I hope you could see that the structure here essentially was that the bulls realized they were in trouble. They had to dump. It drove it down, and the bottom of the market was just convenient. It was the only thing to do was this decay retest, a reduction in risk, gave everybody the opportunity to cover their position. So I don't think the market is fundamentally bullish at this point. But overnight, because of the levels of tension going on right here, and because it's taking profit more than it is selling, I don't know that there's necessarily a bearish tone here. It's like maybe there's people taking bearish bets against the U.S. I think that we have a short-term bullishness to cool off this, and a longer-term bearishness sentiment coming in here because of the oil prices. And by bearish, I mean, sorry, I just used a term and I didn't qualify. There are three levels that I'm looking at here. It's like, short term. I don't do near term, but I guess you could say short and near, but it's long. And then it's just like economic. And long term is like a week for most traders. And economic is like the US is no longer the powerhouse on planet Earth. And so when I said bearish, I mean, I don't think there's people saying the United States is not going to be at the forefront of economies. I don't think that's going on. I think it's that we're seeing attacks coming in. So the United States herself, the US's money, is not changing in value. It's the citizen. And if you're aware of how economies work, if the process of getting the citizen's account balance, so let's say you have $1,000 account balance, the process of getting you from $1,000 to $0 is very good for economies. But once that everybody has no money, so when you get to what would be considered pure socialism, and I'm not trying to be a conspiracy theorist here. I'm saying that as taxes rise, that's good for the economy. But once taxes get to the point where people have no money, suddenly the economy crashes into a problem where people who have no money make no money. And so then you start into the murders. That's when murder happens. So it's also when you lose being the ruler of the world. So increasing taxes looks good because it supports economies while you do it, but it destroys growth. So, I think that the hidden tax on gases is not changing the value of the gross domestic product of the United States. So it's not destroying that. But if it continues to go up and we get to $20 a gallon, and a good EV still costs you, I don't know, $100,000 if you want a good one. Sure, you can get a decent one for $30K, but who wants a decent one? If you're going to get a sweet car, get the sweet car. Sheesh. So until these prices come into like some sort of normalcy, $20 a gallon is basically just a tax because there's no escape, and it's using the monopoly against the citizens to tax them. But the money's not leaving the country, so that's why it looks good. The government's getting a bunch of things done. But then eventually it's like, well, $20-$30 a gallon, nobody has any money. And then suddenly getting things done turns into getting nothing done. And that's when we get that third level, the economic bear, that I think matters. Anyway, that's just my opinion about that stuff. I'm no professional. I have no idea what I'm talking about. Nobody listens to me anyway. So that's where we're at. I hope hearing my thoughts about what's going on in the economy and why things are moving around is useful. I sit and read your guys' comments in the Discord, every single one of them, just because I'm not responding. Doesn't mean I'm not reading them. I just don't always want to respond to everything. Or shoot me messages on Twitter. I listen there. If you're new here and you look down below, there's the Zoom link with the password. You can pop on there every day during market hours. Check out these charts all on your own, All right, I'll see you guys tomorrow.